Okay, in this video we're going to be talking about risk-based equity positioning. If you've been in the chat room, then you've heard me discuss this idea before. And you might want to grab a piece of paper or a note card and a pen, something, because I'm going to ask you some questions along the way. So the idea of this is just to get you thinking in a certain way and to move towards a certain way of thinking and acknowledge some risks that are out there in the world of trading and thereby to try to help you a little bit. So let's just go ahead and jump into it. Risk-based equity positioning, what is it and why is it important? Among the biggest threats to a trader's chances for success are these: lack of experience, trading without a defined strategy, trading without an understanding of support and resistance, the failure to set and honor stops, and the use of too much equity for the risk involved. This video shows you one way to counter one of those threats, the use of too much equity relative to risk. The risk on any trade can be measured by the equity utilized relative to the fixed stop. Once we know the stop, then we can calculate the appropriate equity, but the first step is always knowing and honoring your stop. We can limit our exposure to risk by right-sizing our positions relative to the risk involved on each specific trade. In this way, we can de-escalate the risk on any trade by using the appropriate equity. For example, you would not want to use the same equity or amount of capital on a stock that has a 10% stop as one that has a 2% stop. So what happens when we don't limit our risk exposure? The answer is, if we use outsized equity on high-risk trades, then we are gambling with our equity. It's great if we're right, but it can be financially and psychologically disastrous if we're wrong. If we allow the financial loss on a trade to go beyond our comfort zone of loss exposure, then we tend to make excuses for holding on to the long position. I'm sure we've all said this before, but I can't sell now, it's too far against me, blah blah blah. Our aversion to losing money takes precedence over our objective analysis of the probabilities for success. For example, let's say that we choose to trade a stock long that has gained 40% in the last 2 hours, and this thing is moving up really quick. The problem in the fine print there is the visual of a high-flying stock whets our appetite for risk. It looks like an easy money maker, and we gravitate towards those charts as traders because we think we can make an easy buck there. In the past, maybe we've always used, let's say, $10,000 of equity per trade, and we want to win big. We don't think of the downside. If that trade makes a 2% move above my entry, then I earn $200 on the trade. But maybe it will do more and make up for the loss on another trade, I think to myself. If that trade makes a 20% move below my entry, then I stand to lose $2,000. But I'm not thinking about that. I'm not evaluating my risk. My eye goes to the chart that's zooming up, and I'm trying just to get a piece of it, and I'm not measuring my risk. So if it moves against me by $2,000 where I was only hoping to get a $200 profit, am I likely to sell at that loss? Probably not. If I'm hoping for a $200 win and I'm suddenly looking at a $2,000 loss, then what is likely to happen next? And I'm using a pretty extreme example here, but I may add to the position, for example, in the hopes of getting a better average price, hoping it will eventually work out. So I'm actually adding more risk to the trade since I'm unable to accept the loss. What else happens? I will focus upon this one losing trade, and I will fail to catch other opportunities in the market because I've become obsessed with this one big losing trade. I will think less highly of my trading abilities because I've done this before, and I promised myself last time I'd never do it again, and here I am again doing it again. I will be stressed out and my trade decisions will suffer. If we're emotionally stressed out when we're trading, we're not going to make good objective decisions. And if you're sitting there holding the bag of a losing trade, then that creates stress. If I lose $2,000 on the trade, then I will have to make a large number of profitable trades to make up for this deficit. So just think about that. If I lose that $2,000, I've got to get 10 trades in a row right, making $200 just to get out of the hole. That's not likely to happen. So you can grab a piece of paper and a pen here and answer some questions. This is just an elementary guide to equity positioning. So some questions for you. What is your total equity allocated for day trading? For example, you may have one account, you may have one set of money that you have dedicated to day trading and one set to swing trading, let's say, or one group, maybe another group, maybe options, how much money you've allocated to trading options, or how much you've allocated to trading currencies. So if we're looking at stocks and we're looking at day trading, try to write down what is that number that you have in your account that you're willing to use for day trading. Question number 2. How much are you willing to lose on a single trade? Now this is going to be different for everybody. Each question is going to be different from everybody, but a ballpark place to start is consider a maximum allowed loss per trade of 1 to 2% on your total account per trade. And I'll go through an example of all this in just a second. Number 3, remember that you could have several losing trades in one day. So based on that, state the maximum allowed loss per day with which you are comfortable. In other words, how much could you lose in one day and still not freak out? It can happen. It will happen. Number 4, currently what is your average equity position per trade? So, just right now, what are you using? You may have it preset in your trading platform, but write that number down, what you're doing currently. And number 5, currently what is your process for determining your equity position on each trade? You may have some things already in mind that you're doing, and it's just maybe it may not be written down, it may not be real concrete or specific, but if you have a process, think about that for a second and write that down. You can always pause the video to answer these questions before we move forward. It's probably a good idea. So let me walk you through an example of all this. When I ask what is your total equity allowed for allocated for day trading, let's just use the example of $50,000. You may have $50,000 in your day trading account, you may have $100,000 in your swing trading account, whatever. Number 2, how much are you willing to lose in a single trade? Consider 1 to 2%. So 1% of $50,000 is $500. So you might consider $500 to $1,000 is the maximum you're willing to lose on one single trade in one day trade, and that'd be a lot. Number 3, remember that you could have several losing trades in one day, so based on that, the maximum allowed loss per day. And number 3 there, the answer would be 3 times that. Let's say if I lose $1,500 in one day, then I just stop. If something's not right, it's not a good day, just stop. You draw the line somewhere. And if that's on one trade, if it's on, if you didn't use the right equity and it happens on one trade, then that's where you draw the line. Number 4, currently, what is your average equity position per trade? So let's say currently you're using $10,000. Just as a ballpark, it's an easy, even number, and you're doing that on every trade. So number 5, currently what is your process for determining your equity position on each trade? Perhaps right now is if I like the chart, then I take the trade using 10,000 equity. So those are just some examples of, not going to be exactly what you do, but I'm just showing you how to work through the math and to do this on worksheet for yourself. So here's a simple formula for determining a risk-based equity position. In this formula, inside the little tan box here, the first thing we do is our maximum dollar loss per trade. We already figured that out on the other slide. If you did the worksheet there, you've already got that number. So that maximum loss, we divide that by the stop percentage on this trade. And just to stop here for a second, in the chat room I've been posting the risk on the trades as a percentage because of this whole formula. So if you take the maximum loss divided by the stop percentage on the trade, then you end up with the maximum allowed equity on the trade. So for example, if $500 is your maximum loss per trade and your stop is a 3% stop, then you could use $16,666 as your equity on that trade. So it's a pretty even formula, pretty nice formula. So for example, if we didn't show the example here, but if you had a 10% stop on this trade, then your answer would be very different over here, right? It'd be $5,000 instead of $16,000, and that would help you minimize the risk on the trade. Without a method for measuring risk, you could be using too little equity on low risk, high probability trade setups. So I'm not necessarily trying to convince you to use less equity every time. I'm trying to help you proportion the right amount of equity for the correct amount of risk. So you could be using too little equity actually on these easy, high probability trade setups. You may be avoiding these simple trades because they aren't flashy or they don't pump your adrenaline or excite your endorphins. Likewise, you could be using too much equity on high-risk trade setups, and that could be motivated by a variety of issues, financial or otherwise. And while you might win, you are treating the stock market like a casino rather than respecting it for its ability to punish those who lack the discipline to do things right. So if you want to play this game for a long time and make money at it, then you must respect the law of probabilities. If you're very good, then 80% of your trades will work. That means 20% of them won't work. And if you don't average your risk exposure, then the 20% that don't work can eat your lunch. So some practical applications here. If you're day trading, then you won't have time to get out a calculator and figure the exact amount of equity to use on each trade based on risk-based equity position. Things just move too quickly. That said, you can set up brackets for using various amounts of equity based on a few factors, so you could consider a few of these. The current volatility of the stock or the market. Overall, you want to use less equity than average on highly volatile stocks, because those are the ones that have the most risk. You might look at the price of the stock, and for example, you might use less equity on lower price stocks. Another example is the distance to the stop as a measurement of risk, which is what we've already gone over. So for example, you could use X amount of equity if the risk is less than 3%. You might use Y amount of equity if the risk is between 3 and 5%, and use Z amount if the equity is over 5%. And then finally, you might find it to your advantage that if the risk is greater than 10%, then don't take the trade. Not trading is always an option. So some final postscript, some final thoughts here. Invariably, if you move toward the ideas presented in this video, you will have a trade that explodes in your favor after you reduce your equity due to risk, and you'll think to yourself, shoot Bob, if only I'd used more equity. That's okay. The ego mind tends to favorably remember the trades that go well while ignoring those trades that do poorly. It's what traders do. But track your trades over time. See if you have fewer extreme losses. See if your emotions aren't more on an even keel. Are you under less pressure? Are you making more thoughtful trading decisions? You can also compare your statistics over time. Look at things like your average profit per trade, your average loss per trade, your win-loss percentages, all those kinds of things that are important for traders, and compare those numbers to your past trading results. Over time, if these ideas help you become a more profitable and consistent trader, then you will have avoided one of the chief reasons why traders fail in this business, the failure to use the appropriate equity for the risk involved. Happy trading.